Hello, everyone, and welcome back to Your Finance TV for Friday Musings with Jay Pelosky. How are you, Jay?
Good to be with you, Scott. Happy it's Friday. Off next week here at TPW, so this is a good one.
Well, I'm looking forward to it. And the title of your musings this week are R stands for resilient and R stands for rotation. Run me through that.
Well, I just think that as we look at the half-year point here, where equities globally are up double digits, led by the U.S., where commodities are up double digits, led by both miners and energy, and bonds are lagging a little bit, but down a couple percent. You have to think about where we were at the beginning of the year and the idea that there were going to be, by now, 3 or 4 rate cuts or 2 or 3 rate cuts, not only here, but also in Europe. And, lo and behold, none of that happened, right? We haven't had any rate cuts in the US. We've had 1 rate cut in Europe. And yet, as we touched on at the top here, risk assets have been relatively resilient. And I think that speaks to the economy being better than expected, as well as what the better than expected economy means for earnings, because it really is, and we've been very focused on this at TPW Advisory. It really is about the earnings for stocks in particular. And so we've had a good economic environment. And today's data just reinforces that, right? Core PCE coming in better than it's been for 3+ years. Real disposable income up pretty sharply. I think it just reflects a solid economy, which in turn allows for a resilient stock market.
You also, in that title, you talk about R also stands for rotation. Where are you seeing this? Where are you seeing this rotation?
Well, I just think we've had a master class in equity market rotation in the U.S. over the last couple of weeks, right? I mean, just as the Nvidia hype got to a crescendo, right? What a concentrated market, what a narrow market. It's a single stock market. Just name your kind of hyperbole. Nvidia takes a tumble, right? The poster child, the lead dog for the AI revolution, takes a 15% tumble in less than 2 weeks. And so obviously, if that was the only thing that was holding the market up, the whole market must be down, 8-10%, right? Wrong, right? Barely down at all. I mean, I just checked before coming on. Over the last 10 days, global stocks are up, not down. And that includes the fallout from the EU elections and all the rest of it, the Mexican elections, India, etc. So I just think that's a really important point, which is why I put it in the title, that this market is strong, it's resilient, it's in rotation. So you saw, with Nvidia going down, what went up? Small caps went up. What a surprise, right? What went up? Energy went up. What a surprise. Industrials, retail. People talk about worry, the consumer can't hold up here. The consumer's going to weaken, et cetera, et cetera. Well, as we've talked about many times, we listen to stocks, not Vox, right? And RTH, which is the retail ETF, is not plummeting, telling you that, hey, the consumer is going to, fall out of bed. Job losses are going to spike. We're going into recession. No, the retail ETF is close to all-time highs. And the big dog in that space is Amazon. And Amazon just broke out of a 4-year trading range. And the longer that kind of trading range exists, tends to suggest pretty big moves when the break is finally made. And Amazon is breaking up and out, and that suggests that the retail environment is fine. So rotation has been impressive here. Now we need to watch how it plays out, and maybe we see some rotation to other parts of the world, something we've been kind of positioned for, particularly in some of our emerging market and European and Japanese equity holdings. So that remains to be seen. U.S. has still been the lead dog, but I've just been impressed by how well this supposedly narrow market handled a 15% pullback in less than 2 weeks of its top stock. That's impressive.
Now, obviously, people can go to Pelosky.com to get access to your musings, and they should all do that. But there's another letter R you have in there for reactive, which you don't have in the title. And we're talking about international politics. Like, there's a lot of other stuff happening in the political world out there. France, Mexico, even South Africa. You talk to us about that.
Yeah, exactly. I would have put it in the title, but I thought 3 hours would have been too long. So I decided not to, but I just was kind of, again, it made me think about the political environment you just touched on and what's been going on all around the world. Again, just filling headline after headline, news show after news show, what's happening in Europe, what's going on with France and Macron calling an early election, and the far right going to finally take power in a major European country. Not to mention, we already kind of have that situation in Italy, and things are working fine. What about AMLO in Mexico, as you mentioned, and India and South Africa? And again, my point would be that markets are marching through this, right? This is not being seen as a major impediment to financial risk assets doing okay. Emerging markets, notwithstanding Mexico, notwithstanding India, notwithstanding South Africa, emerging market equities are up over the last 2 weeks. Just checked literally before we came on the show. If you look at Europe, okay, European equities are down over the last couple of weeks, a whopping 2%. Big deal. We're not so fragile, I hope, in this business that a couple of percentage point move gets us all worked up. And so even today, the first round of the French elections are this weekend. Are French bond spreads blowing out? No. It's like a 2 basis point move today. It's still roughly only half of the spread versus the German Bund that existed back in 2015, 2012, 2014, when you had all the worries about the banking system in Europe. And so to me, it suggests that for the most part, markets are looking through the political noise and are focused on those issues around growth and the economy and growth in earnings. And as we've talked about again before, the earnings growth picture is good, not only in the US, but also in Europe, also in Japan, also in China. And therefore, it seems that the markets are focusing in on the right things, which are earnings.
Now, unless you're hiding under a rock, there was something else that happened last night. Maybe it was, I think it was like we refer to here in the US as a political debate. Was any noise come out of that at all, Jay?
Well, there certainly has been, right? But before we get to it, I do want to highlight one part of the world I didn't touch on in that political discussion just a second ago, and that's China, right? China's a market we've talked about a lot. We like the tech space there. We have our 2 tech stack divide thesis where U.S. walling off U.S. tech, China walling off China tech. China tech sells at a 50% plus discount to U.S. tech. We think it's appealing. China has its Third Plenum big policy meeting coming up in the middle of next month. And equities have been volatile. Chinese equities have not been kind of the consistent path that we traced out for the US, Europe, et cetera. China's been quite volatile, had a nice pop. Now it's given a good chunk of it back and is resting on support levels. And so we're watching this Third Plenum pretty carefully. It was delayed 9 months from its traditional holding period. And that suggests to us that leadership in China understands they need to kind of come out with some policies with vigor. And so we're watching that carefully. So I just wanted to put that in there because China is a position that we're well recognized for here at TPW Advisory, and want to keep our clients and your viewers as well kind of up to date on that. So yes, there was a debate last night, if you want to call it a debate, between President Biden and former president and convicted felon Donald Trump, and it was really kind of dispiriting, I think would be one way to put it, at least for me personally, to see that Trump was allowed to just spew lies uninterrupted and uncorrected for 90 minutes. Didn't answer a single question. Was just almost unhinged by the end of the debate, and yet was viewed as the winner of the debate. So that's tells you something about President Biden's performance. And I think the president clearly started off slowly and haltingly, got stronger as the debate went on, as the night went on. But we have had a view that that Biden would win in a landslide, and that view has to be trimmed after last night, right? President Biden, the number one concern is his age, and he looked his age last night, and he sounded and acted like his age, and that is a challenge for him and for the Democratic Party, and certainly for the view that he would win in a landslide. So I don't know what happens, after this politically. Clearly, former President Trump was seen as the winner, though, again, as I say, how someone who just basically lied uninterruptedly for 90 minutes can be viewed as a winner of a presidential debate is dispiriting. But President Biden, maybe it's just a bad night, right? His State of the Union address several months ago was materially different. So we'll see. But in essence, again, going back to the title of resilient markets, if you did live under a rock and came out from that rock, under that rock, and looked at markets this morning, you would have no idea that there was this massive presidential debate, right? Bonds, 2 basis point move, DXY essentially flat, equities up a little bit, more attention paid to the PCE numbers than to the debate. Now, that's interesting to us because on the other side of our Biden in a landslide view, we've been able to hold the view that were Trump to win and implement his policy mix, which Moody's came out this week and said if Trump is elected, his policy mix would likely lead to recession next year. 16 Nobel laureates came out with a letter saying his economic policies are bad for the country. We think that the crux could be the dollar. And so we think a Trump victory could lead to a dollar crash, given the inflationary impact of his extending his tax cuts, blow out the deficit, 10% tariffs on everything, inflationary. The Fed could be put in a box if the Fed cuts, let's say in September, Trump wins in November, and people start to freak out about inflation, and the Fed has to reverse itself. Could be an interesting period, and the dollar could bear the brunt of that. So that's something we're going to watch carefully as the second half of the year unfolds. But for now, we continue to be constructive to risk assets, remain overweight equities, global equities, overweight commodities, and continue to be underweight bonds. I think if the betting really shifts towards a Trump victory, that has to be, I think, viewed as inflationary. Hard to see how bonds can do well in that environment.
Well, Jay, you're obviously taking a week off next week with July 4 coming up. So you have a great week off and enjoy your July 4 celebrations.
Thank you very much, Scott. We are indeed. I did mention that at the top, but yes, happy 4th in advance to everybody. And we will be enjoying our vacation, I can assure you. You have a great weekend, and since we won't be speaking next week, a great Fourth to you and your family.
Thanks very much, Jay. And to all the viewers out there, have a great Fourth and good luck investing.